The US dollar maintains its position as the world's reserve currency and is trusted by many countries. The US government continues to issue Treasury bonds, thanks to its substantial foreign exchange reserves, and the total value of these bonds exceeds the country's gross domestic product. However, some countries are concerned about the US's ability to repay its debts, causing them to sell off their US bonds. According to a report released by the US Treasury Department on April 17, in February 2023, foreign investors' holdings of US Treasury bonds decreased by $58.9 billion compared to the previous month, totaling $7.3436 trillion. This decrease marks a reversal from 3 consecutive months of growth and a $360 billion reduction from the same period last year. The report showed that the 2 largest holders of US bonds both decreased their holdings in February 2023. Japan's holdings decreased by $22.6 billion to $1.0818 trillion, while mainland China continued its trend of selling off US bonds for the 7th consecutive month, further reducing its position by $10.6 billion to $848.8 billion, marking the 11th month below $1 trillion. In February, US bond yields continued to rise, causing significant official buyers who are sensitive to prices to reduce their holdings to diversify risks. Historically, a situation where long-term bond yields are lower than short-term bond yields signifies an impending economic recession. Former U.S. Treasury Secretary Summers also stated that the Federal Reserve's interest rate hikes to curb inflation have not been effective and could lead to a lack of economic momentum. The outlook for U.S. bonds is currently not optimistic, and a sudden decision by a Japanese insurance giant to sell off all of its U.S. bonds has once again signaled danger to the global market. The latest decision by Fukoku Mutual Life Insurance Company, a Japanese insurance giant, has caused market attention. Its executive director and head of investment planning, Yoshiyuki Suzuki, announced that the company would reduce its holdings of overseas bonds by 300 billion Japanese yen in the new fiscal year that began on April 1. This reduction will include cutting its remaining hedged foreign bonds by 240 billion Japanese yen, meaning that Fukoku Mutual Life Insurance will clear out and sell all overseas bonds hedged against exchange rates, primarily focusing on U.S. Treasury bonds in the new fiscal year. It is worth noting that Fukoku Mutual Life Insurance has assets worth up to $65 billion and holds significant influence in Japan's capital market. Suzuki further explained that Fukoku Mutual Life Insurance had planned to invest 320 billion Japanese yen in domestic bonds in the new fiscal year, with 270 billion Japanese yen invested in sovereign bonds and 50 billion Japanese yen in corporate bonds. Fukoku Mutual Life Insurance is one of the first Japanese life insurance companies to develop an investment strategy for the fiscal year 2023, sending a signal of a shift in the market. The total asset size of Japan's insurance industry currently stands at a staggering $2.9 trillion, making it a key player in the global capital market. If other insurance giants also initiate plans to sell offshore bonds, it could have a significant impact on global capital flows. In March of this year, one of Japan's largest insurance companies, Dai-ichi Life Insurance, signaled that it was transferring more funds from U.S. government bonds to Japanese domestic bonds. For investment organizations such as Japan's insurance companies, the sharp rise in hedging costs for the US dollar in 2022 has already eaten up most of the returns from foreign sovereign debt to the point where they are even paying out of pocket. Although the latest trading of US 10-year Treasury yields hovers around 3.6%, the hedging costs for Japanese institutions exceed 5%, meaning that the actual rate of return for Japanese investment institutions investing in one potential outcome of these shifts in the global bond market is a reduction in the value of the US dollar. As more countries sell off their US bonds, demand for the dollar decreases, and its value could potentially decline. This could have significant economic consequences for the United States, as a weaker dollar would make it more expensive for the country to import goods and could lead to inflation. At the same time, however, the U.S. economy has proven resilient in the face of previous challenges to the dollar's status as the world's reserve currency. Despite concerns about the country's debt and repayment ability, the U.S. has continued to issue Treasury bonds and maintain its position as a global financial leader. It remains to be seen how current trends in the bond market will affect the long-term viability of the dollar as the world's reserve currency, but for now, it seems that many countries continue to place their trust in the US dollar's credibility. Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.